Well, good morning, Dale.
And happy Wednesday. Should be Tuesday, but Labor Day, and it was a good Labor Day. Was yours?
Yeah, well, mine was lovely. I had a good time with family. It was
Good.
relaxing. It was calm, which
Good.
actually, yeah, is the perfect segue into what the mortgage market's doing. Calm. There's really not much going on. We had a tiny bit of drama, but it resolved itself today. And as you can see, greening up is good, redding down is bad. The shifts in the market are getting smaller and smaller, which means there's really not much action. So when the Federal Reserve finally sticks their staff and says, we are lowering rates, we're actually not going to see much change. If this comes as a surprise, go watch our last 3 videos or something. We've talked about it plenty, so we're not going to bore you to death again. But Dale, interest rates, what's going on there?
They are stable. They're definitely higher than we would like, of course, but they are stable. I think last week was 6.58, if I'm not mistaken, on the 30-year. 15 years pretty much stable. And, stability goes a long way. So
Right.
it's definitely helpful.
Right, and we're going to reiterate it again, because the Fed says they lower rates doesn't mean that we're going to see a drop. That's already baked into the pricing now. So if it goes up, don't be surprised. Don't come at us and say, you were wrong, Olmsted. It's because you didn't watch our last 3 videos or so. But because of not much action happening on mortgage rates, we want to give a really key tool for you realtors and, of course, buyers on loan assumptions. Dale, give us a quick rundown on what it means to assume a loan.
Very short version, I'll use you and I as an example. I have a house, have a loan on it, you want to buy it. You, for whatever reason, don't qualify, don't want to get another loan to buy my house. You assume my loan, and the
Okay.
lender allows it. But the challenge on assuming a loan that so many people forget is if I'm selling my house for $500 and it has a $300,000 loan, and you're assuming that $300,000 loan, who's going to give me my $200,000? That because 3 and 2 is 500.
Wait. You mean that you're not going to just give me the house for 300,000? Like, you want the market price for your house?
One word answer: no.
Makes sense, I guess. Okay. Yeah, so the buyer has to have the ability to repay. It is at the discretion of the current servicer and lender. And the quickest way to find this out for buyers and realtors and sellers is to go to the current loan's closing disclosure. You would have received this before the loan actually closed, and you'll see the assumption clause on page 4, top left, whether or not the lender will allow, under certain conditions, this person to assume the loan on its original terms. So that 3% rate that you want, as long as that box checked, you might have a chance.
Yep. And I will point out that when dinosaurs roamed the earth before closing disclosures ever existed, the assumability was written right on the note itself. So older loans, that's where you would go to find that, on the note.
Right. Now, Dale, you mentioned very critical concern, market price and the down payment. That's a big one that can automatically throw a wrench in it. We're not talking about VA right now. VA is pretty lenient, and with veterans, assuming veteran loans, that happens way more often than FHA and conventional. So we're going to mainly talk about those two, FHA and conventional, but at the discretion of the current servicer and lender. I want to paint a mental experiment for everyone, a mental picture. Dale, you are my lender. I currently hold a loan, okay, with you. My interest rate is at 3%, let's say.
Okay.
And at current market pricing, it's at 6.5%, we'll say, roughly speaking. I have a person that would like to buy my house and assume my 3% interest rate. Would you like to do that?
Again, the one word answer: no.
Oh.
And here's the reason. Remember, it says will allow. It
Under
doesn't
certain
mean it's
conditions.
a done deal or for sure.
Right.
And the reason is, I would much rather have you go get your own loan, pay me off, so I can take this money that I've loaned out at 3% and now loan it out at 6.5%.
Right.
Because in theory, I'm losing 3.5% every month you don't pay me. So I have no incentive to allow anybody to assume your loan.
Right. And actually, in truth, even if you didn't have an assumption issue, lenders right now that are holding on to 3% loans are losing money even if you hold on to it, because they could sell that money off for a higher interest rate. So it would be their incentive to get paid off as soon as possible. So in truth, yes, even though that box is ticked, typically speaking, it is at the lender's discretion, and if you're going to ask the lender to continue losing money, they will probably say that one magical word: no.
No.
No. So hopefully that is of good help. Check your closing disclosures, page 4, top left, or if it's old enough with the dinosaurs, check the note. And Dale, thank you again for the wisdom.
Wisdom is experience from making bad choices.
Right. We got a lot of that. All right. Thank you, Dale. Take care.
Have a good day.